Day 27. We'll be doing the questions for the third chapter today. So let's begin. Um, First question is, what are the differences among a stop loss order, a limit sell order, and a market order? So let's see. So stop loss order is an instruction to sell a security only when it reaches or falls below a specified price, the stop price. Once triggered, it becomes a market order and is executed at the prevailing market price, which may be different from the stop price. Its primary function is risk management to limit an investor's loss on an existing position. Limit sell order. A limit sell order is an instruction to sell a security only at or above a specified price, the limit price. It guarantees the seller will receive at least the limit price. Okay, so this is basically the target price, what we call the target price. It guarantees the seller will receive at least the limit price, but it does not guarantee execution as the market price may never reach the limit price. Its primary function is to control the minimum sale price and is often used to take profits at a target price. Market order. A market order is an instruction to buy or sell a security immediately at the best available current market price. It guarantees execution but does not guarantee a specific price, particularly in volatile or illiquid markets. Its primary function is to prioritize immediate execution over price control. So let's copy these answers down. So that was question number 1. Now we have question number 2, which is, why have average trade sizes declined in recent years? The decline in average trade sizes in the recent years is primarily attributable to the following interconnected factors: technological democratization, the proliferation of low-cost, user-friendly trading applications, and elimination of commission fees at major retail brokerages have significantly lowered barriers to entry, enabling smaller, more frequent trades by a vast number of retail investors. Uh, Rise of retail participation. Surge of retail investors catalyzed by the above technological shift, and events like COVID-19 pandemic had increased volume of trade with smaller notional values, thereby reducing the statistical average trade size. Fractional share trading. The widespread adoption of fraction share trading allows investors to purchase portions of high-priced equities with very small amounts of capital, facilitating trades that are smaller in dollar value but high in frequency. Behavioral and strategic shifts. Investment strategies common among retail traders, such as high frequency day trading, momentum trading, and thematic investing, often smaller involve smaller tactical position sizes rather than block acquisitions. Algorithmic and institutional fragmentation. Institutional traders and algorithms increasingly utilize order slicing or iceberg orders. So I think the main part is the first 3 points. After that, it's not really that important. And that's the main thing. Basically, like the number of people who trade has increased because of technological advancements and easy accessibility of trading and so on and so forth. So that's pretty much it. Um, yeah, answer three now. Question three: uh, how do margin trades magnify? 1 second. You know what? I'm not gonna use a pencil. It's just not needed. How do margin trades magnify both the upside? How do margin trades magnify both the upside potential and the downside risk of an investment position? So margin trading magnifies both upside potential and downside risk through the use of borrowed capital from a broker to increase the size of an investment position beyond the investor's own equity. Magnification of upside potential. When an investor uses margin, they control a larger asset base with a smaller amount of their own capital equity. Any price gain applies to the total position value, not just the investor's equity. This leverage increases the return on equity (ROE) exponentially. For example, a 50% margin requirement, a 10% increase on total asset value results in a 20% return on the investor's equity, doubling the unleveraged return. Magnification of downside risk. The same leverage mechanism amplifies losses. A price decline is applied to the full position value, which can rapidly erode the investor's small equity base. Using the same 30% margin example, a 10% price decline on the total asset value causes a 20% loss on equity. Critically, losses can exceed the initial investment. If the equity falls below the broker's maintenance requirement, the investor faces a margin call, forcing them to deposit additional funds or have assets sold at a loss to repay the loan, potentially locking in losses and crystallizing a total loss of equity. So basically, there we see how trading on margin and using leverage can be both a positive thing and also a really negative thing if things go bad. So that's why you have to have risk tolerance as a trader and as an investor, and you have to watch how much money you actually take on margin. As a leverage, you have to watch how leveraged you are and make sure you're not over leveraged. And in case of a price decline in the stock's value, you have enough money and value and collateral and other things to not face a margin call. And even if you do, you can answer it basically. Question number four: a market order has so this is I think an MCQ. A market order has price uncertainty but not execution uncertainty. Both price and execution uncertainty. Execution uncertainty but not price uncertainty. So there is no execution uncertainty because execution is just done. It's pretty simple. So our answer is going to be option A, obviously. Let me just check 1 second. Does a market order have price and execution certainty? Oh, okay. Yeah, that's what I said. So a market order guarantees execution but does not guarantee a specific price. It will be filled at the best available price in the current market, which can be volatile. Oh, actually, this is pretty interesting. Uh, the actual execution price may differ significantly from the last traded price or the quoted price at the moment of the order entry, especially for large orders or in fast moving, thin, or illiquid markets. This phenomenon is known as slippage. So that's a new term. Execution uncertainty, timing, and partial fails. Hmm. Yeah, that is not. So, yeah, that's done. So, that's an interesting term, slippage, right there. Answer 5. Where would an illiquid security in a developing country most likely trade? So, this is a pretty interesting question. Illiquid security in a developing country most likely trade? No idea. Where would an illiquid commodity or security in a developing country like India, let's say, most likely? So illiquid security is like nobody wants to buy it. Domestic local stock exchange. No idea. Uh, 1 second, let me ask DeepSeek. Okay, illiquid securities inherently lack the steady flow of public limit orders necessary to sustain an electronic limit order market ELAOM or an electronic communication network ECN. Those electronic venues rely on high trading frequency and narrow spreads, conditions absent in this context. Okay. So what's the option? Answer 6. So yeah, answer 6. D trader opens a brokerage account and purchases 300 shares of Internet Dreams at $40 per share. She borrows so how much is this? 1200. So she borrows 12,000. So she borrows $4,000 from her broker to help pay for the purchase. Okay. So that's like what, 30%? 33.3%. I don't know. It's 1/3. She borrows 4,000 for her purchase. Interest rate is 8%. So what is the margin in D's account when she first purchases the stock? So the margin in D's account will be equal to $4,000 divided by 12,000, which is the purchase, which will be equal to 33.33%. That is like the margin. And first purchase is the stock. If the share price falls to $30 per share by the end of the year, what is the remaining margin in her account? So let me just go over this margin stuff once again, so that I'm clear on that. Buy on margin, here it is. So okay, that's not the margin. Margin is equity by total value, so that will be 8,000. So 66.7 bar is the margin. B, if the price falls to $30 from $40, so the price falls to $30. So then value of stock and price is 30 equals to 9,000. 30 is the 9,000. What is the remaining margin in her account? So now new margin will be equal to 5,000. $5,000 divided by no. I have to put this into DeepSeek. I'm still not getting it. D trader. So initial margin is total cost the stock 300 shares times $40 per share, which is $12,000. Borrowed amount loan $4,000. Initial margin equity equals to total cost minus loan $8,000. Margin percentage equity by total value um, times 100. So that's 66.67%, like we said. Then we have remaining margin after price fall and margin call. I'm sorry, check. So year end stock value. Okay, so year end stock value is $9,000 because price falls to $30 per share and 300 shares, so $9,000. Loan balance at year end, initial loan plus interest 4,000 plus 4,000 times 8%, which is $4,320. Remaining equity stock value minus loan balance, uh, $4,680. Remaining margin percentage equity by stock value 4,680 by 9,000, 52%. Maintenance requirement 30%. Wait, how did we find out the maintenance requirement? Uh, oh, it's given. Yeah. If the maintenance margin requirement is 30%. Okay, fine. So she will not receive a margin call. Okay, so basically what we did is we found the year-end stock value after the price fall to $30. We found the total stock value, which is $9,000. Loan balance at year-end, principal plus interest, which is 4,320 at 8% interest on a $4,000 principal. Remaining equity will be stock value minus loan balance, which is principal plus interest, which will be $4,680. That is the remaining equity. So remaining margin percentage will be remaining the equity by stock value, which is 4,680 divided by 9,000 times 100, which is 52%. So maintenance requirement is 30%. Since 52% is greater than 30%, she will not be receiving a margin call. It's pretty interesting. Uh, hmm. Okay, so the margin fell from 66.67% to 52%, basically, is what we're saying. Okay. Yeah, okay. And then part C was what is the rate of return on her investments is going to be a negative 41.5% rate of return because initial equity investment was $8,000, ending equity value was 4,680. So, 4,680 minus 8,000 divided by 8,000 times 100, which is equal to minus 41.5%. Okay, done. Anyways, answer 7. Let's not waste time on formatting. Who cares, anyways? Answer 7. Why is this like this? Sometimes, man, it really annoys me. Anyways, it's probably my OCD kicking in, but yeah, whatever. Old economy traders opened an account to short sell 1,000 shares of Internet Dreams from the previous problems. So let's read the question. Old economy traders opened an account to short sell 1,000 shares of Internet Dreams from the previous problem. The initial margin requirement was 50%. The margin account pays no interest. A year later, the price of Internet Dreams has risen from $40 to $50, and the stock has paid a dividend of $2 per share. What is the remaining margin in the account if the maintenance margin requirement is 30%? Well, the old economy receive a margin call. What is the rate of return on the investment? So part A, remaining margin in the account. So initial transaction proceeds from short sale, 1,000 shares times $40 a share, $40,000. Initial margin requirement, 50% of $40,000, 20%. $20,000 total initial account value, proceeds plus initial margin. Account value at year end. Cost to buy back shares covered short, 50,000. Dividend payment owed, 1,000 times $2 a share, 2,000. Remaining account value, initial account value minus cost to cover minus dividend owed, 60,000 minus 50,000 minus 2,000, which leaves $8,000. Remaining margin $8,000. Margin call check, maintenance margin requirement 30%, current margin percentage, remaining account value minus divided by cost to cover, 16%. C, rate on return on investment, initial equity investment, initial margin $20,000, ending $8,000. So 12,000 by $8,000 by $20,000 minus 60%. So they really fucked up big time. But yeah, so that's the answer. It's a short sale, so starting was $40 a share, but then they miscalculated and uh, wait a minute, there's no interest here. Okay, because it says the margin account pays no interest. It's pretty interesting. No interest on a loan. It's kind of stupid. Whatever. Uh, okay, question number 8. Consider the following limit order book for a share of stock. Um, the last trade in the stock occurred at a price of $50. If a market buy order for 100 shares comes in, at what price will it be filled? So, price for the market buy order for 100 shares. So, market buy order will execute against the lowest available sell prices, ask prices. Lowest ask price is $50.25 with 100 shares available. The entire 100 share order will be filled at $50.25 per share. Exactly 1 year ago. Uh, so part B is, at what price would the next market buy order be filled? Um, okay, so yeah, at 51.50, which is the next lowest available ask price. So that is that. C is, if you were a securities dealer, would you want to increase or decrease your inventory of this stock? A dealer should increase inventory of this stock. The limit order book shows substantially more buy interest depth at prices below the last trade, $50. Buy orders. That means that people want to sell it. I am not understanding. Uh, buy orders. The bid side has 2,600 total shares. Hmm. Cluster closer last price. While the ask side has only 100 shares at the nearest price. Sparse interest thereafter. Acha. Ask is selling. Bid is buying. Bid is sell. So there's a lot of demand for selling. That means the price is low. That means you should buy. Okay, inventory the stock. Good, good. Understood, yeah. So basically, what it's saying is the price is now low, so it's a good time to buy. So if I was a securities dealer, I would want to buy more right now because people want to sell. People want to sell because the prices are low, so it's good time to buy. It's kind of paradoxical in that nature. So yeah, let's move on to question number 9. Uh, so you are bullish on telecom stock. The current market price is $50 per share, and you have $5,000 of your own to invest. You borrow an additional $5,000 from your broker at an interest rate of 8% per year and invest $10,000 in this stock. So current market price is $50 per share, and you have $5,000 of your own to invest. You borrow additional $5,000 from your broker, trade 8% per year, and invest in the stock. Okay. Uh, we have these questions in the market. What would what will be your rate of return if the price of telecom stock goes up by 10% during the next year? The stock currently pays no dividends. So basically, $10,000, $50 per share. So that's $50,000 in value of stock. So that 5,000 by uh, 50. Uh, yeah, not $50,000. 500. Oh no. Okay, my mistake. My mistake. $10,000 in the stock. Okay. I thought that was the share price. My bad. Anyways, yeah. So $10,000 in the stock. If it goes up 10%, that means $5 it goes up. So first of all, we need to find out how many. So if you invest $10,000 in the stock, $50 worth, that's 200 shares. So we have 200 shares, so 200 times 50, 5. 5 is 10% of 50, right? So now it's $11,000, and that is basically $11,000, and then 5,000 times 1.08, so 5,400 we need to pay. $11,000. So oops, 5,400, 5,600 left. So that would be a 600 divided by 5,000. So we have a 12% rate of return if the price of telecom stock goes up by 10% during the next year. I'm also assuming the stock pays no dividends. Oh, it says 20%. Then there must be some mistake. No problem. Okay. Oh, it didn't consider interest. Interest is charged. Yes, 8% interest is charged. Unfortunately, I didn't read the interest bit. So yeah, I'm right only. The rate of return will be 12% with 8% interest. So yeah, correct. Second part is how far does the price of telecom stock have to fall for you to get a margin call? The maintenance margin is 30%. Assume the price fall happens immediately. So we know the formula for this one. It was given right here somewhere. Yeah, here it is. So yeah, we are buying 200 shares at 200p minus. Okay. So yeah, 200. So the maintenance. Oh, maintenance margin is given. Oh yeah, yeah, sure. So the it'll be 200p minus 5,000. So 200p minus 5,000 divided by 200p equals to 0.3, right? So 0.3 times 200p will equal to 60p. So 200p minus 5,000 equals to 60p. So 140p equals to 5,000. So 5,000 by 140 is the price. 35.714 dollars is the price at which there will be a margin call. 35.71 per share dollars. Perfect. So yeah, that is done. I will be heading out to lunch now. So yeah, that was 9 questions done. After lunch, I'll finish the remaining ones. That's pretty good. Pretty good flow right now. And yeah, I'll see you in the next video. That's it for day 27. Thanks.